Hi everyone, Donna here. I am the owner here at Bookkeeping Made Simple. Today I want to talk a little bit about the various accounting roles and what they do, and why they're all separated out like this. I'm going to kind of start off before I really get started in this by asking if you enjoy this video, if you feel like I brought any value, please like, share, and subscribe. Really sharing the videos is how I grow my channel. So, which is a huge part of my marketing plan. So, with that said, let's kind of begin at the ground level and talk about bookkeeping. Bookkeeping is the process of entering transactions, making sure they're classified correctly, and then producing the financial reports that go with them. The major three financial reports that a bookkeeper will produce are the balance sheet, profit and loss, and statement of cash flows. Now, it used to be that we had a big ledger and multiple other ledgers, and so everything was on paper, and we would call it bookkeeping because we were literally keeping a set of books. So we would have a main ledger, and then we would have separate books for, let's say each person that bought on credit from that company. And we would have to transfer those, make sure they're all posted to the correct place, put them in multiple places. That's where the term bookkeeping comes from. The bookkeeper is the one that enters the transactions. They do make sure that, let's say if you receive a payment on account, they make sure that that payment goes to that person's account. They make sure that that everything historical is correct. So they're the ones that are responsible for recording the transactions, making sure everything is correct. It is, it can be quite time consuming. Even with all the automation that we have today, it can be time consuming. As a kind of a side note, do not trust QuickBooks algorithms if you are accepting bank transactions through the bank feeds. Don't trust QuickBooks algorithms. They will always get them wrong. And I have had to go back in and just absolutely correct them. I've had clients where their income has been overstated by double. So the next step up, once the bookkeeper has recorded the transactions and given you your reports, her job is done. That's all a bookkeeper does. They do not do any analysis. They don't tell you where to, they don't do any advisory. They record the transactions. They give you your reports. Most bookkeepers can't even interpret those reports. Some of them can, we can, but most of them can't. Bookkeepers do not require any certifications. They don't require any education. There's no requirement to be a bookkeeper unless you work for me. And then I insist on experience and education. So that is where we stand. All of the bookkeepers that work for me have at least an associate's degree in accounting. They understand the principles of accounting. That's something that they can do. And they are usually even qualified to be accountants. So I've got one who's in school to be an accountant now and plans to be a CPA in the future. I also have one that has an associate's in accounting from the local college. So, and that's great. They have the education and they both have a lot of experience in both accounting and finance. So if you work for me, you have to have experience and education, but in order to go into bookkeeping, there's no experience required. There's no licensing, there's no nothing. There's no requirements. You just hang out your shingle, so to speak. Now the next step up is the accounting. The accountant has multiple hats that they can wear. The first job of the accountant is to interpret those financial reports that the bookkeeper has provided. They need to do some analysis on them. And by that, that usually means that they're going to be looking at ratios. They're going to be looking at, you know, they're going to be doing the budgeting. So they're going to be looking at, let's say, they say, well, in order for us to grow, we need to advertise, and we're going to earmark 20%. You know, let's look and see how much you have historically spent on advertising as a percentage of revenue. The accountant does all that. They also provide you with your profit margins. We'll talk about things like a current ratio and a quick ratio and AR days and inventory turnover. That's all the job of the accountant. They do the analysis. And hopefully they're also talking to their clients about these analyses and what they need. As a subset of accounting, we also have auditors. Auditor's job, and I realize as soon as I say audit, everybody freaks out. There are multiple kinds of audits that are out there. One is a payroll audit that the state will conduct. That is to make sure that you've classified your employees correctly, if they are gig workers or independent contractors or subcontractors to you or employees. And there are specific tests that they check to see, should they be independent contractors? Should they be employees? This is actually very huge in the news right now, and I will be doing a follow-up video on it. But they're going to check and they're going to see are these independent contractors and were they paid correctly? Or are they employees and was payroll done correctly? Now, I have just audited a client who had a previous bookkeeper who did, I have never seen a more poorly done payroll. I mean, this was spectacularly bad. The client had employees. There is a specific percentage of payroll, of wages that go to payroll tax. There's a specific percentage that goes to Medicare, a specific percentage that goes to Social Security. Of those two taxes, the employer pays half and the employee pays half. This particular bookkeeper guessed. That's all I can come up with. The numbers were round numbers, and so that was kind of my first thing of, this is wrong. Because if you take 7.65% of $150, it's never going to be a round number. It's going to be, you know, if it's $100, I should be seeing $7.65 come out of that employee's check for that particular tax, or for payroll tax. Plus, the employer should be paying 7.65% of the employee's wages as their half of the payroll tax. And so as I was looking at this, I was like, there's no way this should be a round number. This should not be $15. That's wrong. So that was kind of my first thing. I looked, payroll tax was wrong. I also looked and said, withholdings were wrong. You know, it's just, if the FICA is wrong, withholdings are wrong. So we had to go through, and then later on, she didn't even account for taxes. So she didn't account for the employer's half. She didn't figure the percentages correctly. She didn't, it was a spectacularly bad job. And these were actual employees, they were not contractors. So if you have payroll taxes taken out, you're an employee. And I have it on my list. I'm going to be doing a video later about the difference between contractors and employees, because it's in the news a lot. And it needs to be talked about. So you have your accountant that does the analysis, you have your auditor, whose job really is to go in, they test the balances. They want to take just a sample of different balances, and then they want to test it. Is it correct? The most obvious one that they check is they will look and they will pull a statement from the bank and check and see, does the bank account and the company's balance for the same account, do they match? If they do not, that's a big red flag. Kind of the same thing. They will generally go through accounts receivable. They'll take a sample of accounts receivable accounts and test the balances, see if they look right. If they don't, they'll dig further. If they look good, then they'll move on to the next thing. Same thing with inventory. They will take a physical inventory of specific SKUs and make sure that those match what the company is reporting. If they don't, they'll dig further. If they do, they will say, well, if these random ones match, then it's a pretty good chance that everything matches. And then they'll do that for, you know, multiple expense accounts and payroll tax and liabilities, and they'll just kind of take a sample and they'll say if these look correct, then we don't have to audit any further, because we can then say with a reasonable degree of certitude, these are the ones, I mean, this is a reasonably accurate representation of the business. They're not going to say the books are clean and correct. They're going to say this is reasonable. I mean, it's there might be some mistakes, but it's not material. Again, I'll go over what an audit is and how to deal with it in a further video. But the auditors, we have both internal auditors and external auditors. The external ones, the ones people are scared of. The internal ones are the ones that are going back and basically they're checking the bookkeeper's work. They're checking the accountant's work just to make sure that it's correct, so that if there is a problem, they can correct it early on. If there's not a problem, they can be reassured that the company's books are a fair and reasonably accurate representation of the business. Now, once you get past the accountants, the auditors, now we deal with tax preparation. There are 3 different kinds of tax preparers. There is no requirement for continuing education just to be a tax preparer. So use caution. CPAs prepare taxes. I think that's a waste of their talents, but they do prepare taxes. Enrolled agents, or EAs, are my go-to for tax preparation because they are enrolled agents with the IRS. So they have full rights to represent any taxpayer before the IRS in all 50 states and all US territories. And then you have your non-credentialed tax preparer. If you're a non-credentialed tax preparer, they do not have to have anything available. They don't have to have any education. They can guess, basically. However, there are programs within the IRS where you can become not really a credentialed tax preparer, but you can become part of their preparer. Forget what they called it. I just got an email on this like the other day too. But basically, you can tell the IRS that, yes, I will do the continuing education. Yes, I've gone to tax school. Yes, I've done these things. And they will give you, it's not really an enrolled agent, but they will acknowledge that, well, you can represent your clients for the returns you prepared before us, and we'll allow it because we know that you've done the schooling. So if you don't have a CPA or an EA preparing your taxes, tread lightly. I do taxes. I am neither a CPA nor an EA, but I work with an EA who will review taxes for my clients, and she's kind of the one that I depend on if for some reason one of my clients gets audited. I collaborate with her quite a bit. So those are your tax preparers. I strongly recommend that unless you need a CPA because you're a publicly traded organization, you use an enrolled agent. CPAs have limits on what they can represent, and EAs don't. EAs only focus is tax. That is all they do. Now, kind of moving on up. A controller, most people haven't even heard this term. A controller will work with the CFO. We're going to talk about the CFO in a minute. But what they do is they sometimes they're the only accountant for the business. They will create policies and procedures for that company. You know, how do you record a payroll check? They're going to have policies and procedures for that. How do we deal with petty cash? They're going to have a policy and a procedure for that. They create the ledgers, they set up the chart of accounts, they create budgets, they handle the payroll, they do an overview of the inventory, they do everything the accountant does. They usually are then managing the bookkeeper. So basically, I'm a controller for Bookkeeping Made Simple, because I'm the owner. I'm the controller, the CFO, CEO, COO. I am the whole C-suite. But they go over everything. So they run the payroll for the company. They make sure that the bookkeepers are doing their jobs. Their accounting clerks are doing their jobs. They prepare the financial statements. They do the analysis. Now this is where we start to really see them shine. They decide what accounting software to use and what the processes and procedures that go along with it. I really, really, really hate to wear my glasses when I'm doing videos. They also, their job is to safeguard the company assets. So they start looking at, there's risk with every business. That's why business owners hopefully get paid a lot of money. That's why CEOs get paid a lot of money, is that their job is to assess and manage risk. Well, the controller helps to manage risk for the company. And they can do that by, there's 4 ways to manage risk. You can avoid it, good luck. You really can't avoid risk. You can avoid specific types of risk, but you cannot avoid risk altogether. You can mitigate your risk, which would be, you know, maybe I don't want to take this client because they look like they're going to be a problem client. That would be mitigating risk. Also avoiding risk. And they can transfer the risk to an insurance company. And they can accept the risk and say, this is just part of doing business. We're going to put money aside to cover these things. So they do strategic planning, they do risk management, they work with the CPAs on audits. They really kind of run the accounting department. Now, a controller, typically, a bookkeeper service should pay a few $100s a month. A controller usually gets paid a few $1,000s a month, because it is more in-depth. Bookkeepers just enter the transactions. The controllers and the accountants really dig in, and they start making strategic decisions for the company. Now, the next step up is the CFO, or Chief Financial Officer. Lots of people kind of throw this around, and kind of as part of what I want to talk about, I want to talk a little bit about what is called the C-suite. You notice all the top executives of a company have C in the front of their names. We have the CEO, which is the Chief Executive Officer. We have the COO, which is the Chief Operating Officer, who's responsible for the operations of the firm. So I'm the CEO of my company because I'm the executive officer. I'm the COO of my company because I take care of making sure we have all of the Make sure that operations and our clients are being taken care of, that kind of thing. That's operations for us. I am the CFO because I make the financial decisions for the firm. But all of these titles that have chief as the first word of their name are referred to as the C-suite. When we all worked in offices, you would go up to this C-suite, and that's where all the chief officers were. And you can have a chief technology officer, a chief information officer, a chief marketing officer, all of these different departments that are required to run the company have a chief officer involved. These people are referred to, they're collectively called the C-suite. So when you hear that term, that is what it is. So a CFO, the chief financial officer's main duties are to make sure that the past and present financial situation are fine. All of the budgets and forecasting is done based off of historical data. So that's where the accounting really is important. Accountants deal with history. We deal with what happened in the past. Finance officers deal with present and future. So a CFO oversees the capital structure of the company. Now, what that means is there are good reasons for a company to take on debt. And there are also good reasons for a company to issue securities to raise capital. So a chief financial officer is going to look at different strategies and determine, do we want to take on a loan? Or do we want to issue bonds? Or do we want to go onto the stock exchange and issue stock? When you hear about a company doing a stock split, it is the CFO that has made that decision. They decide where should company funds be invested. By that, that means that they're making these capital decisions. Should we buy a new building or should we just lease it? Should we purchase more vehicles for our fleet or should we just maintain the ones that we have? Or should we buy brand new ones or should we buy used? All of that is part of the CFO's job. They also, like the controller, they work with the controllers and sometimes they are the controllers, but they also talk about, they do a lot of risk management. And like I said, there's only a few ways to manage risk. You can mitigate it, transfer it, or accept it, basically. And then there's risk avoidance, but let's be honest, risk avoidance comes with its own risk. Life involves risk. They do look at the reports, they do the budgeting, the forecasting, the looking towards the future part. And they manage the company's money. So there's a certain amount of the CFO's job that is backwards looking, and that's the controllership and the accounting. So they really need to make sure that the financial statements are generated, that they're timely and accurate. It doesn't do anybody any good to see a profit and loss for the first quarter when we're in the fourth quarter. If the first quarter's P&L is just now coming out and we're in the fourth quarter, it's really not helping anybody. We need to see, as I'm making this video, it's October 13th. So I would want to see last quarter's P&L in order to make decisions, and maybe the last year's fourth quarter P&L, and then I can make some decisions about my company about this year's fourth quarter. So they're very important to the stakeholders of the company. Now, let me kind of back up again. There's going to be a lot of, I'm going to define terms here. A stakeholder is not the same as a shareholder. A shareholder or stockholder owns stock in the company. They have an ownership stake. A stakeholder, however, has an interest in the company other than the ownership of stock. So a stakeholder would be, it does include shareholders, but also analysts, creditors, employees, other members of management, suppliers, vendors, customers. These are all stakeholders of the firm. They have a vested interest in whether or not the firm does well. And so the CFO really reports to the stakeholders. Their job is to, one, make sure all the historical information is timely and accurate. They also are responsible for the present financial condition of the company. It's really one of those things where I feel like the CEO is overinflated because the CFO makes a lot of these decisions. So they're going to look into, how do we invest this company's money? We don't necessarily want to keep more than a couple of months of operating income or operating expenses. They keep a couple of months put aside for that, but the rest of it they want to invest so that they receive a return on their investment, because it would be poor stewardship to do anything else. You don't want to just let money sit in a checking account if you can put it in a CD and make even a couple percentage points. They also are going to make decisions about capital expenditures. So they're going to decide, if we have a restaurant, for example, and the restaurant is getting worn down and the equipment's wearing out, I've worked in a restaurant and I know that after a while you can't get it clean anymore, so they may make a decision that we're going to raise the whole thing and build a new building on that site. McDonald's does this fairly regularly. They will just come in, tear down the building, and they'll build a brand new McDonald's on that same site. They want to take into consideration what risk do we have involved in this, and is it something that we can tolerate? Different people have different risk tolerances. We also want to see what the capital structure is like. Now, the capital structure is debt, equity, and internal financing. So, for example, the CFO may say, looking at our overall picture, we want this mix of liquidity. We want this much in loans, this much in equity, and this much in internal financing. And so then they will start looking at, we're going to be taking on this project. Do we want to raise money through equity? That means issuing securities and getting money for that. Or do we just want to take out a loan? And there's drawbacks and benefits to both of those options. So they may say, for this project, given the standing of our company right now, we'd rather raise the money through equity. And in that case, they go to the stock exchange and issue stock, or they issue bonds. Bonds are more of a municipal thing. It's more of a government thing. But a company may say, we want you to lend us money. We're going to give you this bond note. More typically, they will issue stock. Or they may say that the best way of dealing with this is to take out debt. There's reasons to take debt. There's reasons to raise money through equity financing. And that is what the CFO decides. They also are the main player in future financial growth of the company. So what they want to do is they want to see, where are we the most efficient? The CFO is the one that's going to go to the CEO and say, this division of our company, if I use General Motors as an example, the CFO is the one that went up to the CEO and said, Saturn is failing. We need to get rid of Saturn. The CFO of Darden Enterprises, who is a restaurant group, went to the CEO and said, Red Lobster is dragging us down. We need to get rid of that chain as part of our group. And so they did, and their income actually went way up. I did my bachelor's degree capstone on Darden. They need to do forecasting and modeling. So a CFO needs to be not just good at accounting, but good at finance and economics. So the finance and economics part are forward looking and accounting is backwards looking, and you need both. So they are going to really look and see, is it worth keeping this division of the company open? Is it worth keeping this product line producing? Are we making enough money on this line of products to continue to produce them? Which product lines are making us the most money? We need to focus on those. And so what they're trying to predict is what's going to be the most successful. So again, you do need the historical data. So the accountant's job is critical. You need the historical data to be able to do this, because that gives you a basis on where to start. But the critical part of the CFO role is to forecast into the future and say, given this situation, then we want to invest our funds here. And this is what's going to make us the most money. And there is a lot that goes into this. This is why CFOs, by the way, are highly compensated employees. CFOs of large companies typically make as much as CEO. I'm kind of looking at my other screen here. So by example, the CFO of Alphabet, which is Google, his annual compensation is $56 million. So for our CFO programs, we charge multiple thousands of dollars for fractional CFO. And the reason for that is it is a lot of work. It is very labor intensive. It takes a lot of education to get to that point. Let's see, let me kind of look again. So the CFO of Alphabet, the top CFO made $60 million in a year. And that was the CFO of Valeant Pharmaceuticals, former CFO. Now, I don't know what that compensation was. Let me kind of back up on this. I don't know how much of this, I have a table that shows us the compensation rates, but compensation comes in different flavors. So it could be wages and salary, but I don't think anybody is paying anybody a salary of $60 million. I suspect a lot of this is in stock options that have gone up, and some of it's going to be in bonuses, and some of it's going to be in salary. So if you need a CFO for your company, be prepared to pay. I mean, I don't expect anybody that I work with to be able to afford $60 million a year, but I also expect that I'm going to be able to provide enough value to them that they will be happy to pay me tens of thousands of dollars a month, you know, thousands of dollars a month, depending on the size of their company. This is going to be way more than simply bookkeeping or simply accounting. So the top CFO made $60 million. That was a Valeant Pharmaceuticals. The former CFO of Alphabet Group, which is the Google people, was $56.6 million. A former CFO of Oracle made $53.2 million. This is an annual thing. Another former CFO of Alphabet made $31.1 million. Maybe she wasn't as good as the other one. A former CFO of Exxon made $21.8 million a year. So I'm sure some of this was based on performance. So if the CFO helps the company make money, they tend to make more money. And it usually is tied to just like the CEO, their compensation is generally tied in some way to the success of the firm. But I kind of wanted to throw that out there because, for one thing, CFO is a very complex job. It's a very, I can't sit down and do CFO work in an afternoon. I can sit down and do bookkeeping work for an entire year for a client in about, in a few hours, but I can't do that as a CFO, because there's so much analysis. There's so much thought that goes into it. It is a very, very complicated job, and it must be compensated accordingly. So if you choose to hire a CFO or a fractional CFO, which is what it means when you have a CFO that's covering multiple firms, be prepared. They're going to ask for a lot of money. And that is because they produce a lot of value. This is the part, by the way, of advisory service that people really don't understand. Most of my clients don't pay me for advisory. If they did, they'd be paying a lot more. Their job, a CFO's job, is to project into, to take the historical data and then project it into the future. So we want to see the business thrive. There's most of my clients are very, very small businesses, so they're not looking for a CFO. But as we're expanding into advisory service, this is something that I'm really looking into. Obviously, because it's lucrative, but also because I feel like this really is what gives us how do I know what I want to say, but I don't always know how I want to phrase it. It gives us an opportunity to really help our clients grow their businesses. But these would be the larger clients that, you know, where we can do a lot of forecasting and budgeting. So if you are asking for forecasting and budgeting of the business, be aware you will be charged appropriately, accordingly, because that is where the real value starts to come in, is being able to do the forecasting and the budgeting and basically telling the business owners, I want you to spend 20% of your revenue on advertising. I want you to spend 30% of your revenue on payroll. And if you do that, then in this many months, this is the kind of growth we should be able to expect. The CFO is also the ones, if you talk to anyone that works in corporate America and they talk about their department budget, that comes from the CFO. There's a ton of work that goes into it. And to have a really great CFO can make a life or death business for a life or death difference for your business. That's the various roles that I am aware of in accounting. There are more. I will cover audits in an upcoming video. I will also cover the differences between a gig worker or independent contractor and an employee. And as of the law today, this is being debated by the Department of Labor, and I think they should get their little fingers out of that. And why someone might want to be a gig worker and an independent contractor as opposed to an employee. So we're going to cover a lot of things in these upcoming videos. So thank you for watching. Again, if this was informative and entertaining or you enjoyed it, please like, share, and subscribe. I would love to have your feedback on it. And I would also love to see, you know, what other topics you'd like me to cover. Thanks, and I'm looking forward to talking to you again soon.